presentation contains current opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compact Market Wrap Weekly Update for March 24th, 2026. I'm Moe Ansari, President of Compact Asset Management, joined with Javaid Ansari, Executive Vice President, Compact Asset Management. Thank you for joining me today. First of all, I want to remind all of you, go to compact.com, click on Insights, and you can get all of the previous updates that we have posted there. Also, you can click on the subscribe button, so whenever we post an update, you will be notified and you can watch it at your convenience. Secondly, if you're concerned about your portfolio at this time, you're laying awake and wondering what is happening in the Middle East, what's happening here, what's happening there, and what's happening to your portfolio, give us a call. We'll be more than happy to help, get you right-sized, get you going in the right direction, make sure you have the right portfolio. Send us an email at invest@compact.com or give us a call at 800-388-9700. 800-388-9700. We'll sit down with you. We'll develop a plan, not just for the short term, but for the long term, to get you from where you are now to where you want to go financially. Let's start with the numbers, Javaid. Another down week in the markets.
Yeah, markets are, I think, continually concerned with the conflict in Iran. S&P down 1.87%, Dow down 2.09%, Russell down 1.65%. Not as bad as the S&P, so that's relative strength there. EFA down 2.05%. Emerging markets holding up rather well, only down 0.33%, and then the Nasdaq down 2.06%. So now we look at some of these year-to-date returns. We're almost, S&P's down 4.68%, so about 5%. We'll talk a little bit about, we've seen now a lot going on with interest rates and what's happening with the conflict in Iran. We're entering we needed the market to be kind of perfectly positioned with the valuations being a little elevated. We needed things to go rather peachy, throughout the year with earnings and everything else to continue to this upside. And I would say war is anything but peachy and perfect. And so it's definitely throwing a wrench into what's happening. Yet, I would say 5% year to date still seems somewhat manageable so far.
Yeah, so far it's just market surprisingly has held up very well. That's the way I would put it. But the way things are looking, it depends how things go, and no one knows exactly where we are going with this war at this point. If we get, like we saw yesterday, any hint of the ending of the war, Dow was up 1,100 points one time during the day yesterday, ended up about 600 points higher. Today we're just about flat, but depends on which way it goes. If we put troops on the ground, or the first hint that troops might be going into Iran or to the Karg Island or wherever, this market could be in trouble. It could go quite a bit lower from where it is. The first sign that we get that the Iranians and we're negotiating and there's a peace deal to be made, the markets will skyrocket right back up. So no one exactly knows what the outcomes are, but at this point, I would be cautious. What do you think?
I think so. I mean, we talked the year, I was looking at my charts this year, and we'll go through all the technical analysis at the end of the update today. But really, correction of 10 to 15% was going to be really table stakes for the S&P this year, given where the valuations are. That's talking from 7,000, you're going down to 6,000. So we're at 6,500 today. There could be another 500 down points. And I think what the important thing is, that's actually nothing out of the ordinary. And so I think the important thing to understand is if you're really concerned with your portfolio today, given the drawdowns of 5%, and that's a 100% equity portfolio. If you're in a balanced portfolio, you have some bonds. Bonds have held up really well so far this year. Going to start to take a little bit of a hit, and we'll talk about interest rates and oil and inflation. But if you're already concerned today, and you're a 100% equity investor, well, you should be willing to tolerate 15% drawdowns every year in order to get those S&P returns. So if you are starting to be concerned and you, I would say, are more overly aggressive than where you need to be, now might be a time for you to draw it back before we actually maybe do see that 10 or 15% correction. If you're more of a balanced investor, you've already diversified, you've rebalanced your portfolio as the market's gone up really nicely over the last couple of years, I think you're still in a good place. I'm not quite getting those recessionary signals. Now, if oil prices remain high, then we could potentially see a recession, but we're not getting those signals right now, and we'll talk about that. And so that just means you kind of just need to stay the course. It could be bumpy. I'm starting to get some vibes that were similar to 2022, actually. I'll talk about the corollaries there. And that wasn't a great year. Wasn't a great year for the NASDAQ, wasn't a great year for stocks or bonds. But if you held the course, that led to 23, 24, and 25. Which were incredible years to invest and make some headway in terms of your portfolio. So we got to kind of see how things evolve here, but clearly going to continue to cause a lot of disruption with the market.
Last week, again, energy was the biggest sector on the upside, obviously, with the war going on and energy prices hovering around $100 a barrel. That's the question. Utilities were the worst sector, materials down last week. Everything was down. The big question is, where do energy prices stabilize and when they do? If we go to 120, 130 and stay there for a period of time, we've got a global recession. If we're there for 3 to 6 months.
Yeah, but I mean, I was talking about on the YouTube and particularly the podcast over the last couple of months, interest rates were going to move one way or another. Mm-hmm. They were either going to, ideally, we want them to just do nothing. But now I'll talk MOVE index. We'll talk a little bit about my MOVE index, which tracks volatility on interest rates, almost hitting 100 again.
Right.
So we're starting to see some more volatility in the interest rate market. Now, in the end, if I had to pick my poison in terms of where I wanted interest rates to go, I'd rather have interest rates go up than down. Down means we're headed towards a recession. Up means
we've got inflation.
Yes, but I think it's temporary. I look at the key thing that I think is different between maybe even some of the inflation that we saw, the 9% inflation coming out of COVID, is the Fed and money supply. Right. The Fed has actually been curtailing money supply, which is creating dollars, which creates inflation over the course of the last year. In fact, the M2 supply, which is tracking the money supply, which we talk about, is only going up at 4.3%, which is less than the 6% average it usually goes up. So the Fed right now is pretty kind of restrictive, if you will, when it comes to overall monetary policy, at least traditionally. So that really makes, in my opinion, the chances of a long-term inflation or something really troublesome around inflation to not really be a high probability event. Now, yes, we are seeing short-term interest rates go up, oil's going up. I dare use the term transitory because that has a lot of loaded indications to it. But I'm not quite seeing that recessionary kind of indications from the bond market. Mm-hmm. So it seems like we kind of have to just weather this one, like we did in 22, like we did with the tariffs. And yes, if things get crazy and oil prices go to the moon, it's going to be more severe. It's going to be more volatile.
But if the oil prices go up in the short term, they go up to 130, 140, whatever, and they stay there, it's going to slow down all the global economies. And that's recessionary and that's deflation. It's not inflation in the long term.
We're not going to show all the greatest and best charts here on the YouTube. We'd save that for our clients. But I have some great charts that are talking about the economic sensitivity of basically countries. Right. And U.S. and China are not that sensitive to oil and LNG prices as much as they had been in the past.
But it's much more the world is.
Yes, but
South Korea, Japan, Europe.
But that's not where the earnings have been. The earnings have been in U.S. And as long as the U.S., which is now a net exporter of energy, continues to fuel the AI boom and all the infrastructure spending and the GDP growth associated with that, I think we can kind of muddle through this. Now, it's not going to be easy, and it is going to be volatile because stock prices are high.
Right.
And so that's what I'm saying. If you want to be an all-equity investor in this market today, you have to be willing to withstand 15 to 20% drawdowns, 20% is a bear market, in order to get those equity-like returns. That's just the price of admission. And so I tell clients that, and they immediately start getting squeamish, or new prospective clients, and I immediately know they're not an all-equity investor. Everyone wants to be all equities when it's going up, but you really truly find out who is an all-equity investor when the market starts going down.
There's no free lunch in life. To get the returns that you get in the stock market, you have to be able to live with volatility. Mm-hmm. How much volatility you want in your portfolio, That depends on how much you can handle. And I know everybody wants all the upside and none of the downside, but that's not how the world works. You have to be able to take the downside and then figure out how much downside you can take. Once you have that, from there you set a portfolio that will do that and accordingly. And that's how we work. Just going by and buying the Mag 7 is not how the world works usually in the long term. So you have to think of that. Oil pushing $100 a barrel. At the beginning of the year, it was $57 a barrel. So it's nearly doubled, plus or minus.
Yeah, and you know, we had the kind of a little bit of that. Seemed like there was some progression, you know, at least from our side, talking about some negotiations. You know, Iran definitely said there's no negotiations going on. So I think that oil chart is really the one to watch. As long as that, at this point, we're now starting that DBO chart. I don't know, do we have it in the technicals? I don't know if
don't think
we'll start including it in the weekly update. But as long as DBO, which is an ETF I follow on oil, it follows not only the spot price, which is what we're talking about here, but it also looks at the futures. And that's what markets are anticipating oil to be in the next 2, 3, 4, 5 months. And right now, it's really kind of topped out around 21. So as long as that DBO ETF stays below 21, I don't think this is accelerating. And it really then potentially can morph into a recession. Now, if that happens, well, then you got to, you know, monitor it and then look at what interest rates are doing at that particular time. And then particularly if you start seeing interest rates come down while oil is going up, that's, I think, the signal that now that we got a problem. And this is going to potentially morph into a recession, and we're having some bigger issues. Right now, it seems like it's definitely not a problem, but it's not a big problem for the market. And I think it might be creating some opportunities within the fixed income market.
Yeah, 4.5% down for the stock market is nothing for the S&P from where we started.
And there's a war going.
Exactly, there's a war going on. And one thing that I've said for 30 years, you hear me say that all the time. You get bad news in the market and it does not go down. Watch out for the upside. Just like when you get good news and the market does not go up, that means everything is already priced in.
Yep.
That's the way I look at it right now. Treasury interest rates keep on popping. They went from 4.28 to 4.39.
Yep.
That's a big jump in rates overall.
Yeah, so we've seen rates go up, and if you look at AGG for the week was down 0.51%, so 0.5%. But then look at the high yield. This is what I'm talking about. High yield down, not great, but it's down less. This is not recessionary behavior. This is actually, in my opinion, an opportunity where if you've been hoarding cash, now, or if you're short bonds or you don't have a lot of bonds in your portfolio, now you're just on aggregate bonds, you're getting paid 4.66%. Corporates, you're getting paid anywhere between 5.23, 5.5%. Mortgages, you can upgrade, you can lengthen your duration. And why I like potentially buying bonds here, adding a little bit of bonds to the portfolio or elongating your duration if you have bonds, is that if this does morph into a crisis, right, a bigger crisis and a recession, interest rates are going to plummet. Right. And so then you've now locked in that insurance policy that's also paying you back 5.5% in a stock market that is highly valued, that is going to continue to be topsy-turvy. So yeah, being an all-equity investor, I think in today's environment is going to take a really thick skin. And the way you can mitigate that is by potentially adding some high-quality fixed income into your portfolio.
We're at 4.39, and I'll take a look at the chart. It looks like we could be headed to 4.5%, but that's only
4.5. Okay.
Yeah, 4.5 is the next resistance. Here's a chart of correlation. Whenever the volatility goes up, usually the stock market goes down.
That's what we had in 25.
2025. This is the Liberation Day.
Yeah.
The tariff tantrum. But you can see we're nowhere close to the volatility that we saw last year. We saw it around 50 when we're at 30.
Yeah, and the correlation is kind of broke down. Even though we are seeing some VIX is basically people buying protection on the portfolio.
Right.
We're seeing that increase. It's not quite to the same velocity. So while the tariff tantrum, it definitely had recessionary vibes to it.
Yeah, it went straight up, both of them. And the market went straight down.
And high yield was starting to underperform relative to bonds, et cetera. So then that was kind of, if we would have continued down that route of those amount of tariffs, we would have gone into a recession for sure. Now it's kind of a little bit uncertain. And I think that's going to be kind of the name of the game throughout this entire process, is that things are going to be uncertain, and because of that, you're going to see, I think, potentially both big up days, big down days. It kind of swings on, the headlines. Is there progression? Oh no, there's another attack. So there's just going to be a lot of kind of just noise. But that's why I ultimately look at the bond market to give me a little bit kind of a sense of, okay, is this the bond market beginning to price in a recession? And right now, I'm just not quite seeing it. Doesn't mean the market can't go down 15%. But potentially if the market comes lower, like in 2022, stocks went lower and bonds went lower that year. You could have bought anything in 22 and you would have made money in 23, 24, 25. I'm hoping I hope we don't get that much of a correction like we had in 22, but maybe it's a similar situation.
Fed had a meeting last week, believe it or not.
No,
It was a non-event. Nobody cared about it, and that's how it is, and we'll see. At this point, there are people now starting to talk about raising interest rates. The Fed, I don't think they're going to do that. They were talking about cutting interest rates just a month ago. Now they're talking about these opinions go from one extreme to the other. When they start talking about raising interest rates, that's the other extreme. But inflation was higher. It rose 0.7% month over month, putting us around 3.4% for the year.
GDP forecasts have come down. We know the employment market's been kind of not great, not bad. It's kind of muddling along. And so now, Fed rate, there's no expected rate cuts the rest of this year. I don't know yet. I think it depends on clearly where oil goes. But we still had those strong deflationary forces that were happening. But short-term inflation expectations have definitely gone up. And I think that just means that we could potentially be seeing somewhat elevated oil prices here for the foreseeable future. I think that makes it difficult for the Fed to cut anytime later this year.
Not a lot of economic data coming out this week. Not much at all. I think the biggest thing is going to be what happens to the war. The president said he's paused the strikes in Iran's infrastructure for 5 days. But that also is the 5 days that it takes for the Marines to get to Karg Island. They're moving from Asia to the Middle East. Also, we're sending in the 82nd Airborne. It's being deployed to the Middle East now. So is that a precursor to putting boots on the ground? Or is that just a tactic to put more pressure on Iran to come to the negotiating table? There's also talk that we're talking to Iran. We're saying we're talking. The president said we're talking. Iranians said we're not talking. Who knows who's talking and who's not?
I think it's a lot of headlines, and actually war is kind of good for the news industry because everyone's kind of a little bit on edge and tuning in, so they're really going to sensationalize things. I think you just need to look at the oil market. The oil market's going to tell you whether this is getting better or worse. If oil starts coming down, it's getting better. If oil's going up, it's getting worse. And so whatever all the kind of hoopla headlines and all of that is, we need to get away from it. And I think the other thing that I'm also watching, which is a little bit more constructive, because I know everyone's kind of negative with what's going on in the war, is potentially private credit and financials.
Right.
So financials, the sector rotation, financials were up actually last week. They were down the previous week, but they think they were up just 0.4%. They got a little bit of a bid because the Federal Reserve is looking at basically potentially giving a little bit more leeway to the banks to lend, lowering their capital reserves. And I have a feeling that this is also playing into private credit, in the sense that the reason private credit, we're seeing these headlines of the restrictions of the flows and everything else, but I think private credit really exploded because the banking sector was overregulated coming out of 2008. And now that the banks are starting to see a little bit more of a deregulatory environment, private credit has some more competition. And if you have more competition, not necessarily great in terms of your ability to navigate it. But at the same time, I track a lot of the private credit ETFs and where they're headed. They've also seemed to kind of find a little bit of a short-term bottom here over the last couple of weeks. So I think that's very positive. We don't want to see a credit issue, really spiral out of control. And so we're also seeing some positivity there. So, I know it's volatile. We're seeing these big moves, but if you kind of look at a little bit of under the covers, you kind of see things are still okay. And I think particularly the timeline is for us to get to earnings.
Right.
We got to get to earnings
Next
in
month.
April, in a couple of weeks. And so we got this kind of, it's going to be all, I think, somewhat war-driven, oil-driven over the next couple of weeks. Once we get into earnings and we kind of see a little bit more tangible evidence of that economic kind of, our companies are still making money and still doing well, that can, I think, provide a little bit more calm to the market.
S&P, here's the daily chart. Each one of these lines that we're seeing are 1 day of trading, the green and red lines, vertical lines. The blue line is the 50-day moving average, which is 68.43. The red line is the 20-day moving average, 67.08. And this magenta line right here is the 200-day, 66.28. We're below all of those lines, as you can see, at 65.76 last trade, going into the close on Tuesday. So we have broken everything to the downside. We completed 5 waves. Now it starts with wave 1, wave 2, wave 3. Wave 4 will be a bounce, and then wave 5. That's the way it looks. And you really have to start looking at the weekly charts now,
Yeah.
rather than the dailies. And
Yeah.
the weeklies, we're sitting right on the 50-week moving average, 6,500 plus or minus, let's say 64.82. We hit 6,500 on Friday. This morning we are 65,
Kinda right there.
25, and we are right there, to bouncing off of it. If we break that, then we really don't have a lot of support until 6,100.
Yep,
6,000.
That's what I said, around 6,000, which is that's your 15% correction. I don't know if we're quite going there yet. I think it depends on oil.
Yeah.
I think if oil breaks to the upside, yeah, that's your interest rates are going to go higher. We're going to look at a treasury chart here shortly. I think we're now in that 4.4 was kind of on my 10-year treasury. That's kind of now where we're entering a little bit of the danger zone in treasuries. It's been a great time to buy bonds.
Right.
But when rates get that high, it just really becomes a big headwind for the stock market because the valuations are just that much more expensive because you have an alternative. Bonds are starting to look really attractive. And so if that continues, if we continue to see higher oil prices and higher interest rates, I think that's your recipe for easily a 10 to 15% correction. Hopefully nothing more than that. And then it's not morphing into a recession type vibes that we had in not really in 22, just really in the April tariff tantrum. But I think we'll have to wait and see. So that's once again, if you're an all equity investor, you got to be ready for 6,000 on the S&P. And if you're not, maybe now's a good time for you to kind of make some adjustments. I wouldn't necessarily be waiting for all-time highs again, just because who knows where things are headed here over the next couple of months.
Yeah, this is the time to make the adjustments in your portfolio, make the changes so you're correct, you have the right risk allocation in your portfolio. By the time it happens, let's say you're 6,000, then you're already down 15, 20%. If you've got individual alt stocks and you've got go-go stocks, you're down 25 to 30. At that time, there's only one thing to do.
Yeah, you actually got to hold on and continue to go. So
I was going to say pray. But no, I'm sorry. But yeah, then it's too late. It's
Yeah.
already happened. All you got to do is stay where you are. Hopefully it'll come back, the good stocks that you have. If you have good stocks, if you don't, you've got the go-go's, they will be go gone, unfortunately. NASDAQ also below the 200-day moving average, broken below the November low now. The S&P did not. See, S&P is still hanging around right about here, just a little bit
exactly
below.
right around 6,500 is
Yeah.
kind of that. It's kind of this key level here on the S&P where are we going to really maintain less drawdowns and just kind of still work off. Market now has gone nowhere since basically almost middle of last year.
Yeah.
And so
Seems
we'll
like
see.
it's breaking to the downside.
Well, we said beware the dot plot three weeks ago.
3 weeks ago when the dots got above the market, this is the market right here, these vertical lines, and this is the dot plot right here, it got above the market. And that's what we saw 3 weeks ago.
Yep.
We said, watch out on the downside. Once it turns negative, it stays negative for quite a few weeks.
Yeah.
This was 12 weeks right here, 3 months. So, but we are also sitting right at the 50-week moving average. 21,608. Today we were 21,712 was the low. We got last week right to the 21,6 area.
Yep.
So if we break this, then we're looking at somewhere around 20,000.
Now, once again, though, downward moves in the stock market, that doesn't mean you need to sell. And I think it's a question of trying to understand, as the market moves lower, is this a situation where we need to kind of do some risk management, or is this an opportunity?
Right.
Because that's, everyone always says, oh, I don't want to buy at the highs. I don't want to buy at the highs. Okay, well, you're not at the highs now. There's a war going on. There's always something going on when the market's going down.
But
do you want
that's
to
the
buy?
problem with investors. They say, I don't want to buy, it's an all-time high. When the market goes down, they go, oh my God, there's a war going on. I can't buy now. Guess what? They never get in.
Yeah.
You have to be able to buy the market when it goes down. We've seen these, it's not a structural bear market. That's the difference. We've got companies that are still making money. We don't have banks that are overextended. We don't have real estate that's overextended. If you do get a bear market, it's going to be an event-driven bear market. Event-driven bear markets are very short-lived.
Yeah. And
As soon as the event is over, markets snap back up.
very quickly. And so I think that's where you have to look at not only the price declines, but that's where we couple it with the bond market and really trying to understand what is the bond market telling us with this decline. And that really is your guide as to whether, okay, do I hold on or do I add even some risk if I'm a long-term investor and I've been, maybe timed it, reduced my risk because I did some rebalancing, I can actually afford taking some more risk longer term. This is, so we'll guide you through that process. That's what we're here to do on the YouTube and podcast here at Market Wrap. But we're just a big fans of also just educating everyone so they hopefully don't get caught up in what is a very emotional time. And when you basically pile on losses in your portfolio, it becomes very visceral. And that's really how you tend to, we have a saying, when you put money in emotions, you typically have less money. So we want to kind of mitigate the emotions as much as possible. And so by tracking various markets allows us to do that.
There's a small cap. It's also below, this is a weekly chart, 20-week moving average. But it's nowhere close to the 50-week like we saw in the NASDAQ and the S&P. And today we're up about 1.11% on this market. But, we'll have to wait and see. Support is right around 116, and we're still at 124.
Yeah, I don't know about small. I mean, if I was going to be buying some things that are potentially down, I'd be buying some of these nice software companies. They're down a big amount. I think they can kind of come back with a vengeance. I do think international is at the epicenter of they're going to have the most disruptions. This is the IXUS chart. It looks like it went up a lot. Everyone was so bullish on international, saying, "Hey, I need to put all my portfolio in international, etc." And now it's retraced almost a couple of months worth of almost. Now we're back to where we were back in November, December of last year.
Yeah, about 80.88 is the number. That's the 50-week, and we're at about 85. So I think this is wave 3. It's not wave 5. So this is wave 4 on the downside. And then usually we make a fifth wave, which takes us above the third wave high.
Yeah.
So if you get 81 or 82 on this ETF, this is ETF for international stocks.
Yep.
You can take a look at it and see what happens.
And I think it could bounce back with a vengeance. This
Right.
is because it's at the epicenter, and if things do clear up, then this is going to be a pretty good, I think, market leader on the upside going forward.
10-year yields here was the double top that we're looking at around 4.3. We are today at 4.39. We've gone right through that resistance area, broke above it, and now the next resistance is right about here, which is 4.5. Looks like we're headed towards the 4.5, which is 11 basis points. I don't think that, but if we get above here, which is 4.65.
I don't like it whenever we have to go from daily to weekly charts.
We're still on a daily here.
Yeah.
We haven't, but if we go above here, then we'll have to start looking at weekly charts, which give us a longer term picture, and we seem to be breaking out on interest rates. I mean, to the upside, that means inflation is showing that inflation is coming.
Yeah, I still feel as long as the Fed is not pumping the system, it's temporary. You're actually getting a nice opportunity here, in my opinion.
To buy bonds.
Yeah, to buy some bonds. You can basically get paid to have insurance. It's a rare kind of combination of both with fixed income. Given the stock market valuations today, I think it's a pretty good trade-off. So I'd be starting to nibble.
Gold has plummeted. It went from 5,000, 5,100 right here all the way down to 4,100 or 4,000 now.
Easy come, easy go.
Yeah, it's volatile, but 375, 3,750, that's GLD 375 is the number I would be looking at.
Yeah, I think it's tough to trade gold at this stage, or just kind of get in and get out. I don't know. But if you want to have some gold in your portfolio, you said, hey, I needed some more gold. You didn't buy it. Well, now you have an opportunity to add a little bit.
Here's HYG. This is the high yield. You can see it's below the 50-day, which is right here, below the 50-day and the 200-day exactly the same today, which is interesting. But the 50-day breaks below the 200-day. That's called the death cross. I don't know.
Yeah, but once I think maybe we'll update it for our listeners. Maybe put that relative strength chart up on here.
Okay.
Because I think that's ultimately, HYG going down is not great, but if it's going down less than bonds, it's just going up because interest rates are going up. So
We'll put a relevant chart which shows you the relative strength of the HYG compared to the AGG. AGG is government bonds. HYG is lower category bonds. So we'll put that chart in. As long as that chart is going up, that means that the HYG is outperforming AGG. That is good. It's going down. That would not be good.
not be good.
So those are our thoughts. At this point, folks, again, emotions are running high.
Yep.
The trick in markets to make money over the long term is to stay unemotional. I know money is a very emotional subject, but that's the hard part. Not to make emotional knee-jerk decisions because you sell at the lows and you buy at the highs when you do that. You want to buy at the lows and sell at the highs. But buying at the lows means you've got to buy into bad news, which nobody wants to do. It's counterintuitive, investing is. And that is the hard part of investing. Your mind says something and your heart says something else. And trying to reconcile that is hard. Give us a call. Subscribe to this channel. If you need help with your portfolio, call us right now, 800-388-9700, or send us an email at invest@compact.com. Those are our thoughts. Those are observations for this week. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.